What if I told you that selling your Malaysian property just 1 year too early could cost you over 100,000 ringgit? When it comes to property taxes, Malaysians eventually pay zero, but foreigners never do. This is real property gains tax, the exit bill no foreign owner escapes. Today, I'll show you exactly how to time your exit and legally shrink your tax bill. Selamat datang. I'm Brian, 10 years foreign in Malaysia, researching the property maze for myself, sharing what I find, one episode at a time. Here's something Malaysians and foreigners do not share equally. A Malaysian who holds a property long enough pays nothing when they sell, zero tax. A foreigner never reaches zero, not after 6 years, not after 20. This is real property gains tax, RPGT, the exit bill no foreign owner escapes. Let's understand it before it surprises you. First, what RPGT actually taxes? Here's the first thing to get right. RPGT is not a tax on your sale price. It is narrower than that. It taxes your gain, your profit. Take the price you sell for, subtract what you originally paid, plus your allowable buying and selling costs. What's left is the chargeable gain. And that, only that, is what RPGT is charged on. So if you sell at a loss, there is no chargeable gain and no RPGT at all. The tax only ever lands on profit. And one more thing, it only triggers when you sell. Hold a property and never dispose of it, and RPGT never touches you. Second, the rate table. A Malaysian citizen and you. Let's put the rates side by side. A Malaysian citizen on one side, a foreigner on the other. Sell within the first 3 years, both pay 30%. So far, the same. Year 4, a citizen drops to 20%. A foreigner stays at 30%. Year 5, a citizen drops again to 15%. A foreigner, still 30%. And year 6 and beyond, here's the gap. A Malaysian citizen pays zero, nothing. A foreigner drops too, but only to 10%. That's the whole story of this episode in one table. For a foreigner, the rate sits at a flat 30% straight through years 1 to 5. No taper, no easing, and then settles at 10%. It never reaches zero. Third, the 7% held back. When you sell, something happens on completion day that catches a lot of foreign sellers off guard. Your buyer's lawyer does not hand you the full sale price. They keep 7% of it back. This isn't optional, and it isn't your buyer being difficult. When the seller is a foreigner, the law requires it. Section 21B of the RPGT Act. Here's the flow. On completion, your buyer's lawyer retains 7% of the total sale price. Within 60 days, that money is sent to LHDN, the tax office, as a deposit against your RPGT bill. Then, once your tax is assessed, if you overpaid, LHDN refunds the difference. If you came up short, you top up the balance. The key point, that 7% is a deposit, not the final tax. It's collected upfront, so the RPGT bill simply cannot be walked away from. Now, since 2025, one more thing changed, and it puts the responsibility squarely on you. RPGT moved to a self-assessment system. What that means? The return you file through e-CKHT on the MyTax portal is accepted as your official assessment. The tax office takes your figures as given, so those figures have to be right, and there's a deadline. Both you and your buyer must submit RPGT returns within 60 days of the disposal. Miss that window and a 10% penalty is applied automatically. Put those two together. You calculate the bill and you're on the clock. And the conclusion is simple. For the sale, appoint a Malaysian tax agent. Get the numbers wrong in your own favor, and the shortfall plus penalties is yours to carry. Fourth, how to legally shrink the bill. Here's the good news. RPGT taxes the gain. So every ringgit of allowable cost you can prove lowers what the tax can reach. 6 things you can deduct. 1. The legal fees from buying the property originally. 2. The legal fees on selling it. 3. The agent's commission on the sale. 4. The stamp duty you paid when you bought. Yes, that includes the foreign buyer rate. 5. Renovation and enhancement. Improvements that added lasting value, not routine repairs. And 6. The cost of the sale itself. Advertising, marketing, what you spent to find a buyer. But here's the rule that makes all of it work. No receipt, no deduction. Keep every invoice from the day you buy. LHDN needs documentary proof of each cost. There are 2 exemptions in the RPGT system. As a foreigner, you get one of them. The one you do get, an automatic exemption of 10% of your chargeable gain, or 10,000 ringgit, whichever is higher. Every individual gets it, foreigners included. It comes straight off the gain, before the rate is applied. The one you don't get, the once in a lifetime private residence exemption, a completely tax-free sale of one home. That relief is for Malaysian citizens and permanent residents only, so your RPGT floor is real. But that automatic 10% exemption, that one is genuinely yours on every sale. Fifth, Year 5, Year 6, and the math between them. Let's make this real with numbers. Say you bought a property for 1.5 million ringgit. Years later, you sell it for 2.3 million. Start with the sale price, 2,300,000. Subtract your original purchase price, 1,500,000. Subtract your allowable buying and selling costs, let's say 100,000. And subtract the automatic 10% exemption, that's 70,000. What's left is your taxable gain, 630,000 ringgit. Now watch what the timing does. Sell in year 5, the rate is 30%. Your RPGT bill, 189,000 ringgit. Sell in year 6, the rate drops to 10%. The same gain, the same property. Your bill are 63,000 ringgit. The difference for waiting a single extra year, 126,000 ringgit. That is 6 figures kept in your pocket for nothing more than patience. 6th, one zone where the rule is rewritten. There is one place in Malaysia where the foreigner RPGT floor is genuinely lifted. Pulau 1, Island 1, or Forest City in Johor. Under legislation gazetted in October 2025, a non-citizen who sells a Pulau 1 property in or after the 4th year of ownership can be exempt from RPGT entirely. And on the way in, there's a 50% stamp duty remission on the purchase. That is a real, gazetted difference, not developer marketing. But 2 cautions. It applies to Pulau 1 of Forest City specifically, nowhere else. And eligibility conditions apply. If this is on your radar, confirm your position with a Malaysian tax advisor before you rely on it. So here's Brian's exit checklist. 5 things. And notice that most of them happen long before you sell. 1. Keep every receipt from the day you buy. Legal fees, stamp duty, every renovation invoice. 2. Know your year 5 and year 6 dates. The rate drops from 30% to 10% the moment you cross them. 3. Budget RPGT into your exit, not your entry. The bill lands when you sell, never when you buy. 4. File e-CKHT within 60 days of the disposal. Both you and your buyer are required to. 5. Appoint a Malaysian tax agent for the sale. Self-assessment means those numbers are your responsibility. If you remember one thing from this episode, make it this. For a foreigner, RPGT never reaches 0. So plan the exit before you ever sign the entry. Sell inside 5 years, expect 30%. Hold into year 6. It falls to 10. Knowing which side of that line you're on is the difference. That's RPGT, the tax that never quite reaches 0 for a foreign owner. It taxes the gain, not the price. It drops at year 6 but never to nothing. And every receipt you keep makes it smaller. Next episode, State Consent. Why your purchase can sit and wait 12 weeks for a single signature from the state government. If this helped, subscribe. And tell me your whole period in the comments. I'll run the year-by-year RPGT math. Stay curious. Stay careful. Brian out. See you in the next video.